Hello, this is Jim Ruggiero. Today is the 22nd of February. This is the roundtable. Mark Ansel doesn't appear to be able to end up joining us. So what I was going to end up doing is that I've known Mark for probably about 5 years. We have some shared colleagues that we've built trading systems with and around. So what I'll end up doing is at least build the framework in and around what it ends up taking for a system like what Mark ended up building. Mark's system is, number one, it is proprietary. Mark ends up trading as a prop trader. For those of you who don't end up knowing what a prop trader firm is, it's basically a firm that just trades its own money. Before we get started, just a quick disclaimer. Capital Discussion is not a broker-dealer, investment advisors. Trading options, it carries many risks. You should be aware of all risks before placing any trades. We have no way of knowing what level of risk is appropriate for you, so you should be aware of all of those risks prior to placing any trades. We're not going to be talking about computer simulated trades, but when we do, please realize that they are computer simulated. Okay, your results will vary because of such things as commissions, slippage, and other factors. When you're building a trading system, and Mark and I and another firm that we both worked with or had association with in Fort Lauderdale, there's several factors. Okay, the first approach that we end up taking a look at is, and you've heard me ask this question many times when I've looked at other people's trades, what is your edge? If you can't clearly define what your edge is, you don't have a system. Now, edge can be defined in many, many different ways, but it's something that's going to give you a statistical advantage. One of the things that I used to hear floor traders talk about is what's your edge, and they would go through things like, for example, 20 years ago, somebody could say, well, I was the fastest in the crowd. I'd be able to calculate the prices, and I would be the first one to put up my markets, my bid and ask. And that was a great advantage back then, which means absolutely nothing now because the computers are doing it. It still is important, but it's now who has the fastest computers, who has the fastest network, who has all the colos. And so it's a very, very different market than it was, years ago. You have to understand that most prop trading firms don't have nearly the number of traders that they once did. And the reason is because computer programs have replaced most of them. You also have to end up realizing that the market-making activities and anything that had to end up doing with higher frequency trading, quick trading in and out, those advantages are gone. And I do mean 100% gone for retail traders. Unless you're putting in multi-million dollars a month into your network and have the fastest computers, the fastest network, there's just no way you can end up competing with the high frequency trading firms. So now you need to take a look at, well, what's your time frame? I will end up telling you that what Mark ended up doing, where most prop traders are, most prop trading firms make their traders go home flat at night. Mark trades futures, which means that he needs to close his positions every single night. And then when the markets open up again in 15 minutes, a half an hour, depending on which markets he's trading, he can end up reopening his positions. But the overnight is when the markets close and then they end up resetting, and they all close for at least some short period of time. He has to end up being in cash. Mark ends up having a system where he's only going to be making a couple of trades a day. He'll end up establishing one position. If he makes his profit, he'll end up getting out. He will end up getting in a second time and possibly even in less certain times, a third time. But he's only holding his position for a short period of time. He's looking to make a few points, maybe as many as 8 on, let's say, the E-minis. He'll end up trading 3 different markets. The E-minis, he'll end up trading crude oil, and he'll end up trading the euro. Now, when you're looking at a system, okay, it depends on what you're looking at. He's developed a system where he has great edge in terms of he's done so much homework in and around pattern recognition, what ends up going on with the market. He establishes a position. He tries to end up trading a mini counter trade, meaning that he'll look for a daily direction. If it's up, he'll wait for a small pullback, get in, then try to end up taking the major direction up. And he goes through that. He'll go through his math, okay, and he'll end up being able to show how, in a simulated environment, in a back-tested environment, he'll end up having edge. When we look at any trading system, option or otherwise, okay, you need to end up taking a look at where you can end up having your edge. When I take a look at trades, let's take a look at, the Vol Vantage one, okay, that I've started going in is, still free for the rest of the month. I've taken a look and I've done an extensive amount of getting data, more than is publicly available, right? One of the edges, okay, or how I built edge was one, getting the information of what all of these VIX-based ETFs were going back to when the VIX future started to trade. If you know their formulas, which, by the way, are clearly stated in the 350 pages of their prospectuses, when you go and find their formulas, you can actually calculate what the price would have been for each of these ETFs or ETNs before they actually started the trade, and you can end up going back and you can end up finding it. Now what ends up happening is I have a much, much larger set of data than anybody who didn't do this work, number one. Number two, I've gone through with multiple quants, physics PhDs, math PhDs, and we've gone through and we've taken a look to see what the markets look like. Now, here's a very important point, because I think that anybody who looks at a trading system, you have to do the following. You need to take a look at where your markets can be that define how you will end up making money, and you can also end up defining how you have greater risk. Okay, that's really, really important. So when I take a look at this, and this was something that, the firm that Mark and I first met at, as I had mentioned, is a Fort Lauderdale-based company. What we ended up taking a look at is where the risk would end up being in different market environments. And here's the way we define market environments. We define market environments as one, define which direction the trend is. Now, obviously, if Mark's going to end up trading in and out in a day, he needs to look at a much shorter time frame, 5-minute, intervals, 10-minute intervals, versus if I'm looking at a positional trade like a Vol Vantage or any of the, the options trade alert services, things like, the Kevlar or the road trip trade, they're looking at, 60, 75-day periods, where the fruit fly would only be looking at, say, a 14-day. So now I have to define my trend a little bit differently in which directions it's going. However, I also then need to end up doing, I need to determine whether it's up, down, or sideways. And then what I need to end up looking at after that is what's the movement, or what's the volatility within the trend. The best way to take a look at, I shouldn't say the best way. There are multiple ways, and I know Mark looks at it in many, many different ways. But the simplest way and the easiest way to measure is whatever period of time you're looking in is to end up looking at the true range, right? The ATRs, the average true range. So if I'm looking at a daily basis, at a daily basis, what I'm looking at is the high minus the low, including any gaps of each day. Now, when I'm trending up, I'm trending sideways, or I'm trending down, I have to take a look at how wide that range is. So let's talk about a system like Mark's, where he's trying to end up capturing it. He will end up defining his range, and let's say he'll end up defining his ranges up in a day. They'll then take a look at what's a average or a reasonable period where I can take a look at as we're trending up in a direction. We're going to have a lot of little counter moves where we'll go up, pull back a little bit, then go up, and then pull back again. In those in those bars of where we're going up or pulling back, how wide are they? What does the channel look like? And when you're trading a momentum system, okay, you'll end up figuring out, okay, the market's moving up, and so I definitely want to go. But when you have a pullback back to the bottom of that channel, getting long at that point, okay, is the way, a system would end up working where you could end up having an edge. And then if the trend ended up continuing going higher, then you would end up selling once you got towards the top of that trend. Now, this is where the whole key comes in. How do you define where that trend is, the tops, the bottoms? How do you do your math behind all of that? A lot of programs, computer programs, will basically run algorithms on a lot of these types of trading systems, where they'll define here's where they're going to end, here's where they'll end up getting out, based on a lot of heavy-duty math. There's a lot of repeating that goes on, and what happens with trends many times is, I don't know if you've ever heard the expression, the trend is your friend until it ends. So where Mark has advantage and where most trading systems that do have, statistical advantage is that they've worked to define a knowledgeable way of figuring out relatively accurate that here is the current trend. They will then end up defining, okay, the bottoms of the trends and the tops of the trends going forward, and have defined points of where they're going to be coming in and where they're going to be going out. And they can end up then testing it in different markets. One of the biggest, I think, problems that many retail traders have is that they'll end up working, and sometimes they'll have these great systems at their disposal. But if it doesn't work, 1 month or one trade or two trades or three trades in a row, okay, that's it, the system's broken and they leave. No, statistically, this is going to happen. You're not going to win every single trade, okay? If you end up chasing the trade du jour, okay, this trade is working now, I'll end up getting in here, and I'll go with this. Or what ends up happening is I can almost guarantee over the long term, you're going to lose money, because no system works all the time. And if you go and use the system that's currently working, one of the things that's almost a guarantee is that at some point, if it's working incredibly well now, at some point in the future, it's not going to work as well. There was a great article in Barron's, probably about 3 years ago, maybe 4 years ago, where they took a look at all of the Morningstar ratings. They took a look at funds that were upgraded to either 4 or 5 stars. They gave it a month after, okay, the 4 or 5 stars, so it had settled out. Okay, any price movement of people wanting to move in because it was upgraded was all taken out. So they waited 1 month, and then they invested for a year. They did the same thing with anything that was downgraded to 1 or 2 stars. They waited a month, and then they invested in those, okay, for a year. And what they found was that the downgrades actually slightly outperformed the upgrades. So if they were downgraded to 1 or 2 stars, because one of the things that ended up happening, and there was a certain time frame, right? They were looking for ones that had longer-term ones, and so they were looking ones that had a short-term downgrade. And so the reason why is because there are many, many systems that have, edge. They have probability. But if you end up waiting and you only end up going after they worked for a long period of time and they haven't had any pullbacks, statistically, they're not going to work 100% of the time. So how do you determine, right? How do you determine whether a system has edge or not? Right? I mean, this is the biggest thing, right? This is the biggest crux in the whole area that we take a look at. And what we would end up doing, Mark and I and the firm that we were with, we would end up taking a look at how how the systems performed in different markets. The first thing we would do is that we would end up getting a good understanding of where their edge was, what they were taking advantage of, what type of markets worked well for them, what type of markets were, let's say, more challenging. And what we ended up doing is that we would look at those environments, and then we would go and we'd look at the performance when those markets were particularly good or particularly difficult. Sorry about the noise. I didn't expect to be hosting this, and I'm actually at an outdoor cafe in Boca Raton, close to their airport. Anyway, the edge that we'd end up having, let's say, Mark's edge is when a trend continues, it's established, and then he'll end up finding the counter trend, the pullback, and then he'll end up getting it. And so what ends up happening is that he has specific ranges. Like, for example, in the S&P 500, how many points is he going to end up trying to get? Remember, he's looking at a daily range. So what he's trying to do is he's trying to end up finding anywhere from a few points up to maybe about 8 points of a trend. Okay? And so we'll take a look at things like that, and we'll say, well, what happens if the trend becomes smaller? What happens if it reverses? What ends up happening if when he gets in, the trend goes up, but all of a sudden, we end up getting in at a low spot, and then the trend stops going up and it starts to go down. And so you start to take a look at how much money your system can make in good environments and how much money it can make when it's more challenging. Let me give you, a real-life example. And let's come over to here. I'm going to end up showing you the performance of the Kevlar, right? Because I don't want to share anybody else's performance because, I won't know specifically about why certain things did work for them or didn't work for them. Ask any questions, by the way, in the chat as we go through this. If I take a look at the Kevlar, okay, and let's take a look at performance. Okay, now let's take a look at by expiration month. Okay. What I'll end up doing, and you can end up going to the individual trades and see the individual trades and where we are and what the performance was, what the margin was. So the first thing you take a look at and say, how do you measure performance? I will tell you that many, many people have what I call a denominator problem, where they may have $50,000 in their account, but their trade only ends up using, let's say half of that. Oh, well, I only used $25,000, but I could use up to $50,000. But since I only used $25,000, I'm going to take my profit and I'm going to end up dividing it by the $25,000. No, that's wrong. If you allocated $50,000 for the trade, that's what you have to end up dividing it by, plain and simple. I had been asked this question, several times because you also have to take a look in your system is how efficient your system is. Mark and I have had this conversation that, he uses usually at least 2/3 of his capital. Sometimes he'll use all of it. You do need to keep some capital in reserve for many trading systems, so this way you can end up doing your adjustments. So, for example, I had been asked about the trades that I did for January and December. Okay, and if you take a look at these, here's February, December, January, and February. And they said, Jim, I don't understand. If I take a look at your start date and your end date, like, for example, your start date was October 17th. You didn't get out of it until the 7th of December, but you started the previous trade. You say you're only using $50,000 in the account, but when I end up adding these two, because the thing is that there's this period here from the 3rd of November to the 7th of December where you have two trades that have overlapped. And it's not like they went away, because in the very next trade in February, you see after the 7th, when you close this trade in December, by the 16th, you opened up the next one. And so you're using 46, 32, and then 37. You're using way over $50,000. And if you look at the individual numbers like that, I can understand how people might end up making that mistake. And here's where, you need to define your edge, define how you're using your capital, how efficient you are. This specific trade ends up scaling in and scaling out. So as I scaled up and I used the maximum of used the maximum of $46,000, what ended up happening here was that I used the $46,000. I used the $46,000 for a short period of time. As I started to scale out of this trade, I would scale into the next trade. So at any time when you added the two trades together, they weren't more than $50,000. Now you can end up always seeing that, at least on our website, where excuse me, I go to open. Now I only have one trade that's open, and so you can end up seeing here how much capital is being used. Right, the $43,000 and what we end up having left. And so you have to take a look and see how you're using your capital, right? That's very, very important. That's almost like a precursor to understanding a trade, understanding, where good markets are, where bad markets are. Okay, let me make this simple, all right? I'll just tell you where the good markets are and where the bad markets are. 99% of the time, the hardest market, for the Kevlar is going to end up being when you have these grind them up markets. They're moving up, they're moving up, they're moving up, and then you have another burst higher. And if you take a look at what's happened since the election, since the election, we've had basically this, moving higher, maybe pause for, a few days and then move higher again. And this, you can see where my performance over the last 4 months has been, rather strained. It's been difficult, right? This is the most difficult market that I end up having. Now, how often do we end up having these uninterrupted periods of time where you just keep grinding up? Yeah, it does happen sometimes. It can happen for 6 months at a time, or more. What happens more often than not is, we will get these movements up for, a few days, a few weeks, even a few months, but then we end up having a pause or a pullback, and then we end up going up again. See, my time frame is that I look at monthly or even, let's say, a 3-month chart the way Mark Ansel will look at a daily chart. My time frame is much longer. Now, you need to end up knowing where your markets are, where you're strongest, where your markets are that are weakest. Now, while I end up having a struggle making money, I also know that my risk, no matter how high the markets go, my risk is going to be limited. Yeah, I can be down 5%, I can be down 10%, but it's not that huge of a deal. It's not like I'm going to lose 40, 50% if the markets end up going up and I'm in more trouble. And so what ends up happening is that you have to take a look and see what that ends up meaning to your performance and where your risk is. Remember I told you it's the most difficult market 99% of the time. The 1% that would even be more difficult is what would end up happening if we have a major pullback. Now, here's the way I'm defining a major pullback. The markets are closed and we gap 10% or more. Let me give you a little bit of perspective. On the worst trading day of any of our lifetimes, unless you're over like 100 years old. The worst trading day, of my lifetime was in 1987. On that day, when the markets were down 22%, we got down 9, not 10, 9. So I'm talking that type of ugly day. Now, what happens when we had pullbacks? And you guys can take a look at the performance here. You know what ended up happening, the pullback we had in January and February, of last year. How did I end up doing during that period of time? And you can see, it performed very well. Now, the way I end up measuring performance, I always measure performance on the account. I think the account's there to end up going, this is how much money I've ended up allocating. I've allocated $50,000 to the account. How are we performing on the account? And so even though I may not use the full amount of money, okay, what does my performance actually look like? Okay, because the $50,000 there is there to end up trading. Okay, and so that's really, really important to understand how you're getting your total performance. And so my percentage on the capital that I ended up either having in the account or using, you can see, by the way, in the first couple of months, I said, "Ooh, I made money," so I started to end up actually using the money that I made, and then I ended up changing because I realized that some people who hadn't been in from the beginning couldn't end up using all of the money. Like for example here. And just a quick comment. You can see here on these first 2 months, I ended up making $8,000. So in the next month, I used 55 of the $58,500 that I had in the account. Right. So I didn't use more. But I stopped doing that because as people would sign on, they couldn't end up using the money that I had previously made. Okay. Now that being said, I can also take a look at how did we do through Brexit? Right, because we had this really bad pullback in Brexit, and that was in the end of June. And so I take a look at, how did we do during these months? And so you can see by just a simple analysis saying, wow, the system actually does better in flat and down markets than in, these rocket higher, move markets. And the answer is definitely true. That's the way the Kevlar ends up working. And so I end up getting asked sometimes, what would performance end up being in different markets? I'd say, you got 16 months here. You have up markets, you have down markets, you have flat markets. I can tell you that, my performance, which I've been asked before, can I end up sharing? And the answer is I'd have to get approval from too many people. It cost me a lot of time and effort and money to end up getting it approved by the different companies. Because, by the way, the reason I can't end up sharing is I was a professional money manager. I was licensed. Okay, I worked for, I was licensed under FINRA. I worked with companies that were audited or had to end up reporting to the SEC. And FINRA and the SEC have very, very specific rules about if you're ever going to share performance, what you have to end up doing, all the documentation. It's a major effort and pain in the butt. And I'm not going to end up doing it. I'm not going to go through that expense. And by the way, any prop shop, they'll end up asking you for some records, but they'll want to know much, much more what your trading rules are and what your performance ends up looking like in different simulated environments that they will put together. And the best thing you can ever do when you're looking at any system for yourself is saying, how does this end up working? How does this system, how did it perform? In up markets and down markets. And very importantly, how does it end up looking at certain points? You may see a system that looks absolutely great and say, oh, look at all of this money that, it made in this specific trade. Go and actually watch the performance of it, day by day or watch it live, because what happens if the system's down 5%, like, we are right now, in the Kevlar, and what happens if the market moved another, a 5 points or 10 points? Would it be disastrous? Would it be like, oh my God, I'm going to lose 50%, if we end up moving? That, you saved it at the edge of the cliff. This 5%, whereas if we move up, I lose a couple more dollars. Whereas if we pull back into the butterfly, this will end up making a lot of money. So right now, while my loss is the greatest, loss is the greatest at this current point, I feel that I'm kind of risking, $1 to make 2 or 3. If we move up, I might lose another $1. If we move back and we pull into the butterfly, I could easily make 2, 3, or even more dollars for every $1 at risk I have if we move up. Those are great risk rewards. So understanding the trade and where you are in an options trade is absolutely critical. It's a little bit easier in a futures trade or in a stock trade, right? Because here you basically have dollar for dollar because you're long, right? Or you're short. And so if you move up, that means you have another $1 of risk. So at what point do you start to pull the plug? In some ways, futures and stock trades are much, much easier because if they move, it's a one-for-one. And what we end up doing is that we're not one-for-one traders, right? institutional options guys always call these one-for-one traders, we call them, they're delta one traders, right? Because they're either long a delta or short a delta. Their deltas don't change. They have no gamma. They have no vega. They have no theta. They're just a delta one trader because he's long the options. It goes up $1, you make $1. Now I realize, okay, in the future, if it goes up $1, you don't make $1, you make $12.50. I get that, but still, you're making the same amount of money if it goes up or if it goes down. And so taking a look at that now and then putting it all together, that's what's absolutely, critical. And so, that's the way the inputs, or at least the way you go and you judge any system that you're developing or you're looking at. There are a couple of questions I want to end up going. In crude oil, okay, the reason why we were talking about the Kevlar was that Mark isn't here, and I had no way of, going over his specific results, right? He keeps them, and he'll end up going through. And I asked him, he wasn't going to end up doing crude oil. He actually was redoing the presentation because I know a lot more people trade the S&P, so he was going to end up showing you results on the S&P, even though he believes that in his system, and his results back up what his beliefs are, that his system is more profitable on oil than it was on the S&P. Given that, what we ended up taking a look was I wanted to be able to end up talking about how to go and evaluate a system. And instead of sharing somebody else's without their approval, I figured I'd end up sharing the Kevlar stuff since it was mine. I could end up showing you, here's the weaknesses of the systems. These are markets that are difficult to end up trading. These are markets that make it more simple to trade. Okay, and so these are the factors that go into looking at any trading system. Let me take a look and see real quick if Mark has joined us. He wasn't there a little while ago when I took a look. Yeah, unfortunately, he's still not here. Anyway, that's what I can end up telling you when you're looking at an overall trading system and some of the things that you should end up looking at. Okay. Any questions about looking at, a system or a single system and being able to end up evaluating it? I'd be more than happy to answer any questions you guys have. Okay, I don't see anything. Go ahead and write in your questions if you can think of anything. And if not, I'm just going to make one more comment about this is the way you look at a single system. Okay. Next. Not every single system will work in every environment. So what you need to end up kind of figuring out with in environments that are more challenging for your trading system, whatever you're doing, okay, what you need to think about is where your risk is. In a bad trading environment, how big is your risk? In the Kevlar, I talked about, my most difficult environment is when the market just keeps moving up and up and up and up. But my risk is rather limited on that side. So I don't have a lot of fear, and I can stay in trades a lot longer, and it gives me an edge of not being forced to end up having to adjust. And so that becomes very, very important. The same thing with, if you take a look, the same thing with, say, the road trip trade, where it's only the broken wing butterflies. If the markets move up and up and up, it's more difficult to end up making money. They get smaller profits. But if it runs up to, infinity and beyond, their potential loss is rather small, and it's capped, as is in the Kevlar. So having your most difficult trading environments and a way to be able to control your losses is absolutely key. What happens in most, I'm going to call them Delta 1 systems, again, future systems or stock trading systems, are, since you're a one-for-one trader, if you're short and the market keeps going up, or if you're long and the market keeps going down, your only way to stop the pain is to close the trade. And so therefore, the reason why prop shops, as I mentioned in the beginning, make traders go home overnight flat is because there's going to be that 15 minutes, hour and a half where they can't trade. And during that time, they can get gapped. If the markets are open, they can end up taking action. Okay, so that's the first thing. How do you end up protecting getting really hurt? One of the great things about IBD, Investors Business Daily, and the whole William O'Neill, how to make money in trading stocks. One of the trading rules that he ended up having in stocks was don't take losses of more than 7 or 8%. And that's because losses will kill you. If you have a 7 or 8% loss, right? Even do this. Let's say if I have a 10% loss, and I go down to, I have $100,000. I have a 10% loss. I lose $10,000. I go down to $90,000. Well, if I make 11%, back, I'll end up taking care of my loss. So if you have like an 8% loss, you need to end up making less than a 9% gain to be flat again. If you take a 50% loss, you have to end up making 100% on your remaining money to get back even. You take a 75% loss, right? Now you need to end up making 300% to get back to even. Okay, and so taking big losses is absolutely devastating. So you must end up taking a look at what your risk is when you do have risk and you're losing trades. And one of the things that Mark does very well in his trading system, like all Delta One systems, are he controls his losses. Mark's system ends up working in a way where, and I'm going to give you an example, and it's not specifically Mark's, it's somebody's that Mark and I worked with together. But what they would end up doing is that they would put 3 units of risk. Okay, they could put up to 6 units of risk in total. Okay, they'd put in 3 units of risk to start. If it moved against them, they'd end up putting in 1 more unit. Okay, if it moved against them again, and there were certain conditions, they'd put in a 5th unit. They'd never use their 6th unit. Their 6th unit was for reserve. If they ended up losing at that point, they were out. Okay, they would stop themselves out. So now you know that, my maximum risk within a day is 5 units, and he wouldn't end up trading anymore. If they made their money on their 3 units, that money would go into the bank. If they got another setup, they would put on another trade. And sometimes, they could get 2, 3, or 4 trades on, but only when they were winning. Okay, only when they were winning. And so therefore, when you take a look at what their average wins were versus their average losses, and that becomes important. Not just their average wins and their average losses, but also what was their biggest loss, because you're going to care about that a lot. Is there a way they can get really gapped, that they can get really hurt? And again, it's not just what their loss was, but what's their theoretical risk during that time. Because they can end up, again, having just huge risk, but, they went to the edge of the precipice, but they didn't go down the cliff, right? They were able to save themselves because the market ended up returning. And this is the problem, by the way, with systematic backtest. What they'll end up doing many times with a systematic backtest is that they'll pick these great points where they happened to stop themselves out and they didn't have those big losses. And then what ends up happening is they say, well, we got out, when we ended up losing, 6.7%, because the thing is that as soon as they went by that, it ended up being a 35% loss. Well, what happens if next time, it's not 6.7%, but it's, 5%. Once you go past that, it goes down to 30%. So you need to understand where the real risk is. And many, many times, you can't figure that out. What we've been trying to do, Tom Nunemaker and I have been trying to do in Capital Discussions, is explain the trades. These services are really so that you can end up learning, of where your risks are, how to end up managing those risks. And yes, sometimes, trades are going to move against you. There's no question about it. But how much risk was on the table when you had that ugly move against you? There's another question here: is how do we end up calculating losing streak odds? Losing streak odds are done by the following. You take a look at what your wins were over here and what your losses are. I didn't mean to go that far, right? So the Kevlar, and these are only on closed trades. So my one open trade is not here yet. If at the end of the trade it's still a losing trade, we'll end up having 14 wins and 2 losses. Next thing, you end up taking a look at what your average profits were on your winning trades. Okay, and you can see that, okay, just under $3,200, and what your average losses were. You also want to end up taking a look at what your maximum drawdown was. How much did you end up, okay, losing, okay, from your gains? Okay, you can end up seeing those numbers here. So the odds of losing 2 in a row, it's just simple math, right? So it's going to basically be, 14 and 1. So the average of losing 2 is going to be, 14 raised to the second power. Okay, 14 times 14, and it goes through it. And so basically that's going to end up being 225 to 1. Okay, and how many times is it's going to? This one is going to be, 14th raised to the third power, the fourth power, the fifth power. So all it's doing is it's just doing math. It doesn't mean that these are the real odds. It's just saying based on this performance and on this distribution, if we do the math, if we had the exact same 15 months, okay, over and over and over again, and we started doing, a true Monte Carlo simulation, what would the odds be? Okay, so it's doing the math the way the industry ends up doing it. Probably one of the most important factors are, expectancy, and expectancy can be calculated a couple of different ways. If you end up hitting the question marks next to these, Tom will take you to the page where it ends up explaining exactly what it is. But this expectancy says for every 1 unit that I wager, with my wins and my losses combined, what can I end up expecting to make? Now, your expectancy has to be positive, right? If you end up having $1 at risk, how much can I end up expecting to make? Now, including your winnings and your losses, you'd want to be able to end up, having some type of a positive number. Okay, the more positive your number is, the better, okay, your expectancy. Okay, and again, like I said, just if you want to read it, just hit the question marks and it'll take you to the website. Any other questions about trading systems or how any individual trading system works? Okay, I don't see any other questions. So I'm just going to make one last comment about how to look together towards a portfolio. And I'm going to talk a little bit about correlation, okay, because every investment management, RIA, registered investment advisor you go to will talk about how they end up going into non-correlated, investments, meaning that, or inversely correlated investments, meaning that, investment 1 might end up not doing well, but investment 2 isn't correlated, so just because investment 1 isn't doing well, investment 2 can end up doing well. You take a look at things like, say, U.S. Treasuries versus U.S. equities. Usually, as U.S. equities are going up, it's not the greatest in the world for U.S. Treasuries. Usually, when the markets are tanking, the equity markets are tanking, and it's terrible for stocks, usually U.S. Treasuries are going to go up. So there's going to be a negative correlation. The problem that I have with correlation, okay, and this type of analysis in 2017 is that so many trades are computer models, and it's computers trading. Okay, even their portfolio systems, while it may be individuals actually putting the trades on, their models are going to end up being computer-based models. When, the crap hits the fan, like in 2008, correlations go to 1 or -1, meaning that gold and treasuries did incredibly well. Everything else, I don't care if it was high risk, low risk equity stuff, they all got crushed. All correlations end up going to be just absolutely, a terrible, terrible way in times of market stress. The other thing when you're taking a look at a system is just because something hasn't happened before doesn't mean it can't happen in the future. For those of you guys who haven't read about long-term capital management, go and read about it. And what you'll find is that the trade that basically took them out and almost destroyed them, and there were several of them, several bad trades. But the worst one was what they were betting on the correlation between things like a 10-year treasury and a 9-year treasury. And when markets panicked, okay, in and around the whole Asian contagion thing back in 1998. Everybody went to end up buying new issues of treasuries, and the 10-year treasuries had a 23 standard deviation difference than the 9-year treasuries. And it wiped out these, Nobel Prize winners and these, PhD quants because they had never seen those type of correlations. So the correlations are, important, and they can end up making money. The challenge that you end up happening is that you still need to end up saying what happens if. What happens if the correlations stop working? I take a look at the Kevlar and say, well, what happens if the markets just keep grinding up? Well, it means they're probably going to end up losing, 5-6%, okay, in a bad case. Can it go up to 10? Yeah, it can go up to 10. What's the worst it can get? Probably in that 10 to 12 range, no matter what ends up happening. So my worst case scenario in my difficult market is something I can live with. Does that work for you in your trading system? Is it only just one trading system, or do you have multiple investments? The other thing that I end up doing that you guys have heard me say is that I end up putting the Vol Vantage trade in the same account that I have the Kevlar trade because, as I told you, 99% of the time, my worst market is since the election, and the markets just kept grinding higher and higher and higher, and I'm, slightly down money. If you take a look after the election, I actually made money on the November trade, which was 10%. So if you take a look at the date since the election, I'm actually up slightly, a few percent. The Vol Vantage trade, okay, makes great money in this grind 'em up, low vol, high skew, terrible trading environment that we have for the Kevlar. The Vol Vantage trade is up nearly 50%, okay, during the same time frame. So I have two trades when one does poorly, the other does very well. Okay, the other environments, okay, then going to the 1%, what do you do when the markets are absolutely horrific? You take a look at, well, what was the performance in like 2008 when we ended up having that September, November, October, November, downturn, and in October, okay, the Vol Vantage, okay, from using the same trading methodology, the models say and the backtests say the exact same thing, that it would have been up over 100%. So in a very, very difficult environment where the Kevlar may have ended up, doing much poorer, okay, and we would have gotten out on max losses, I had other systems that ended up making well. Now here's the whole thing. Let's talk about correlation. The Kevlar is basically working off of the implied volatility of the S&P 500. The Vol Vantage is working off of the implied volatilities of the futures, the volatility futures of the S&P 500, the VIX futures. And so that correlation is nearly 100%. So I don't have the risk of, both utilities and financial companies both ended up going up and down, and usually that doesn't happen. They're not very correlated, and all of a sudden everything got ugly, and they are. And so when you're developing your method of how you plan to end up making money, you need to determine all of this stuff for yourself, okay? What makes the most sense for the way you guys end up trading and what you're most comfortable with, okay? Another question came in, okay, if I'm making efficient use of capital on the Kevlar, how am I able to allocate money to Vol Vantage? It's a separate trade, and if you end up taking a look at the Vol Vantage, what I ended up doing is that I put $50,000, okay, as an account value into, okay, the Kevlar. I would consider a neutral allocation in the Vol Vantage to be another $25,000. It's not the same money, right? It's another $25,000. I didn't want to end up just being neutral. I wanted to be able to end up having trading shares and putting more money when we ended up having very positive markets like we currently end up having in the or we've had over the last several months in the XIV, the long XIV trade. And so that's a totally separate allocation. Instead of 25, I put $35,000 into it. So you can end up seeing that over here, whereas if I come in and I take a look at Volve, I did that wrong. Let's come over to here. and take a look at settings. Oh no, you won't see that there. It's on my settings. You can end up seeing here account size is $25,000. I'm sorry, $35,000. So separate trades, separate accounts, and that's the way you need to treat them. By the way, if you have 2 trades or 3 trades or 10 trades that all work together, you need to end up doing everything separately and then aggregate them together to see how they'd end up performing. When one is bad, the other is good. But treat them all separately, measure them separately. How else are you going to end up knowing where the performance is coming from unless you treat them completely as separate trades? And that's what I do, and that's what I try to end up showing you guys. Okay. With this, I don't see any more questions. I'm sorry that Mark wasn't here. I try to end up covering as much as possible in and around what it takes to end up building a trading system. To recap, number 1, you need to define what your edge is. Over what time period? Okay. Number 2, you need to end up determining what markets will be good for you and what markets will be bad for you. Where will you be able to make your most money? Where do you have your biggest struggle in trading? Number 3, you need to take a look at what your levels of risk are, how much you're going to end up making or losing, not only on average, but how theoretically good or bad it could end up being. Okay? And then you need to end up, if you're evaluating a system, you go, once you have all of that information, you go and you take a look at, well, how did it perform in markets that they said were attractive for it, and how did it perform in markets that they said were difficult for it? And how much risk did they end up having in both of those environments? Those are the ways you end up doing it. The last point that we ended up talking about is that when you're evaluating a system, what markets are good or bad, I end up drawing a tic-tac-toe type of box, but with 6 squares. Okay, along the vertical axis, it's going to be is the market going up, sideways, or down, and then along the top axis for each one of those 3, I'm going to say, what's the range? Is the range wide per day or wide per period that you're investing in terms of your bar chart, or is it narrow? What happens when you go from one box to another? What happens when I go from a sideways market with wide bars to a upward market with smaller bars, smaller volatility? When you're making a transition from one market into the other, where are your risks? Okay, those are the ways that you end up taking a look at this. The more you do this, the more performance you end up looking at, the more you'll be able to end up seeing where you're going to have challenges. Okay, guys, again, I apologize that Mark wasn't here. I tried to end up covering the best I could, with 0 notice, and I hope this was useful for you. I'll talk to you soon. By the way, some of the videos are not being posted, immediately the way they are. Tom and his wife are taking a well-deserved vacation, and he's a little bit slow in getting them up, but hopefully he'll have this up by tomorrow or the next day. Anyway, have a great day, guys. I'll speak to you soon.